Hello, and welcome to Palisade Corporation's webcast, The Use of At-Risk with an Online Investment Portal, presented by Charlie Strout. My name is Jameson Romeo Hall, and I will be your host today. And I'll be available to help answer WebEx technical questions by chat. If you experience technical difficulties joining this WebEx session, please dial 1-866-229-3239. At this time, all attendees are in a listen-only mode. Please note that as an attendee, you are part of a larger audience today. The attendee list is suppressed to maintain attendee privacy. We will be holding a Q&A session at the conclusion of today's presentation. You may ask an online question anytime throughout the presentation today by clicking on the chat icon located on the floating toolbar. I would also encourage you to visit our website and sign up for a free trial download of our software, including our lead products, At-Risk, and the Decision Tools Suite. We invite you to sit back and relax and enjoy today's presentation. And Charlie, you have the presenter ball.
Great. Do I have to do anything? Or
sure. Go up to your left part of your screen, upper left, and hit that Quick Start tab.
Okay. And then share.
And then you can, yep. Looks good.
Great. I'm a little bit. There we go. Am I going?
Oh yeah, looks good.
Okay. Well, first of all, thank you, Jameson, for having me, and thanks for Palisade software, not only for this, but for all the work that you guys do. I'm a big fan of your Decision Tools Suite, and just thanks for giving me the opportunity to give this presentation today. My name is Charlie Strout. I'm one of the two co-founders of Prudena.com. And I'm going to give you basically a little bit of a walkthrough about kind of what Prudena does, how we use at-risk on some of the things that we do, what we're going to do in the future. And as Jameson said, if anyone has any questions, I think if you just send them to him by chat, and then at the end there'll be a bit of a QA, and I'm happy to answer whatever I can. As a bit of a legal ease, like I'm not an investment advisor, so please, nothing is to be taken as investment advice, and this is sort of educational purposes only. So I just don't want to get in trouble with anybody. All right, but let's get started. Okay, we're going to begin with Prudena. Just for a big background we'll go with a little story, the sort of the cocktail party stock tip. Everyone's sort of been there. You're talking to someone, they know about some kind of company. It's going to be really good. This is a little story in 3 slides about a friend of mine named Alfred. Alfred goes to a great cocktail party. He gets a great stock tip from a good friend in the know. His friend's really smart. He mortgages his house. He gets you to mortgage your house. He puts it all into a ton of stock. And the date is September 2nd, 1929, which I don't know if any of you are aware of your history, but that's a particularly bad day to buy to buy stock, and even worse, to mortgage your house. So this story might be a little extreme, but people have found, and academic research has found, that this pattern sort of kind of repeats itself over and over and over. So one of the things that we're really trying to do at Prudena is to create some real simple tools where, in the simple case, maybe you do hear about a company, maybe you're really actively following your portfolio. You have just a simple way to get a back of the envelope idea of what's going on with the company. Figure out which questions need to be asked and answered. Just give you a little bit of insight into what's going on very quickly. The moral of the story is we don't want to be Alfred. We want to be informed people who understand the risks, the upside and the downsides of things we're doing. And there's a lot of reason for this. Some of this is that a lot of academic research has said that if people have a better understanding about the risks they're taking, when things actually go against them, they're much more comfortable. So anyone who's in investment advisory or any kind of that role, really, if you can sort of through simulation get people to experience what can happen when things go wrong, if it actually does go wrong, unfortunately, they'll be much more understanding of what that is. Prudena is a website. Again, this is our goal. Prudena, half of it means prudent. And then una is together. So the idea is that together we can make better decisions and be more prudent. So we have some very straightforward kind of portfolio monitoring tools. We do some Monte Carlo simulations on the site. We've been kind of actively going. We're relatively new, sort of actively going for just a couple months now. Personally, I use it as a place to go where I monitor kind of my investments in my portfolio on a daily basis. Kind of every morning I get up and I sort of take a look at what's going on. Anyone who uses like Yahoo Finance or something like that, in some ways it's a replacement for that. I used to use some of those other tools. Now I just go to Prudena. So our philosophy of Prudena, we're basically one part behavioral economist. We believe that people are sort of rational animals, I guess, but have a lot of tendencies, and there's a lot of propensities to behave in irrational ways. Many investors have said, including Benjamin Graham, that a lot of times the biggest risk of an investor is the investor, him or herself. So we're very focused on the psychology and treating people as people, not as sort of some fully rational agent. We're two parts value investor. We're extremely, we really believe in the philosophy of value investing, kind of understanding the root economic drivers of a company. We're certainly not, day trader type or chartists. That said, we are also partially behavioral economists, so we do understand how emotions can impact the market. And we're not out to say that the market's wrong, and because we know better because we're value investors. We're just kind of combining those two. And I say we're one part card counter because card counter is someone who uses math, kind of their guts, a system that they stick to, and they use that to create a system that they believe over time is going to give them a little bit of an edge. As part of being a card counter, you may be up some, you might be down some, but if you're doing it well and you're doing it right, especially with, like blackjack or something, you can have an edge and you can kind of beat the system. It's very hard, but I think you sort of need to have that very disciplined mentality of someone like that. And also, it's kind of fun. So. One of our core beliefs is that we believe that accounting is a window into the soul of a company. There are lots of things in the news that can be said about a company and their products and whatever it is, but when you dig into the accounting, and if you understand the accounting on what's going on in a company, it can just give you tremendous insights about how companies are allocating the resources, the troubles that they're having, all of these things. There's a famous story about John D. Rockefeller Jr. and one of his nephews was, talking about some great new technology, that they were doing some oil fields down in Texas and kind of going off and off and on. And, John D. Rockefeller was like, look, that's great. I understand this technology is amazing. I know you're really excited, but just remember, it's the figures that matter at the end of the day. So when you have a company, you have to see what's the story and what's really going on in the figures. So I'm not going to get too much into this, but it's one of our background sort of basic simple models that we use. It's the residual earnings model that is presented by many people, but where I learned it from was from Professor Stephen Penman at Columbia University. The reason I like this model, one, it is quite simple in that it's not that big. When you look at it, it's not some massive spreadsheet or something. But even though it's not big, it sort of encapsulates all the major drivers. Okay, you have value, which would be, depending on what you're doing, it's either the market price of something, or it could be what you think the value should be. It's got the book value, which can be important. If you look in 1999, a lot of internet companies didn't have anything on book value, and that can be important. Then it has a concept term of residual earnings, which is, for now, we can sort of brush over that, but basically think of it as, how much it's worth because of the earnings of the company. And what your required return is, and the growth. So this is basically just a slight sort of change on a traditional cash flow model. It's completely consistent with a cash flow model. And again, one of the things we're really trying to do, part of it is we're talking about risk, right? You know, at risk and Palisade software, and what we're doing at the site is we're trying to not be out for it, not buy something that is completely risky and we don't understand why. So what this allows us to do is we can say, okay, if you look at this formula, say the market value, we know what that is. The market's going to tell us. Whether it's right or wrong, we don't know, but it's kind of a fact what the last price was, what the last person was willing to pay. The book value, we can look up the financial statements. We know it. Now, I say sort of know it because maybe we don't believe what the company's telling us. Maybe we don't really think the book value is what it is, but in sort of a back of an envelope initial shot, at least you can look it up and it is a fact, at least what they said it was. The residual earnings are the same way. We know it, and we could say, look, there's an earnings estimate for this year, and there's an earnings estimate for next year. We know what back earnings were. We might have a pretty good idea. So we can feel fairly confident that we're reasonably close to that. Required return, like we can decide. So again, that's a fact. We can say I want a 10% return on this, and that's the very thing. Now growth, that's the last term that everyone knows. Like growth is, and high implied growth and a lot of growth is something that can get people into trouble. So one of the first things that we're going to do is we're going to plug what we know into this formula, market price, earnings, book value, and we're going to see what the implied growth rate is. And this is going to give us some insight just on kind of what some of the issues are immediately on investing in a particular equity. So as I said before, if you look back in the past, companies with very high implied growth rates, I'm not going to say some people haven't made a ton of money on them, but they can be very risky. So let's go now to Prudena. And okay. So this is for Apple Computer. This is as of today. And what this basically does is it takes that simple formula and it does all the work for you to bring it all in. From data sources, it gets earnings estimates, it gets the balance sheet data, it gets the market price, brings it all in, plugs into the formula, and gives you just a very simple chart. And what this shows you is that if you look at Apple Computer, it has a lot of cash on its balance sheet, so a certain amount of value is just coming from what's on its balance sheet. It's a software company, so it traditionally doesn't have a lot of hard assets, but they do have tons of cash. So in some ways, it's a very believable number that that's worth. Then, if you take what's on the balance sheet and then you figure, okay, I have a couple earnings estimates, and if I just put that out into the future, what would that be worth? And that gives you this number. And then this last column is what the market says the value is worth right now. Excuse me for 1 second. We can see here that the market doesn't think Apple Computer is the great growth story that it used to be. It's basically saying that sort of the long-term growth rate is, and this is residual earnings, so it's not earnings, which sort of is a distinction, but it's basically they're saying it's going to go along. It's not a huge growth story going forward. But what we'd like to say here is in a very simple way, you can all of a sudden say that, look, if Apple Computer doesn't completely fall apart, they're probably going to be worth the stock price that they are. If you think that Samsung's going to take them down and their next product is not going to be worth anything, then obviously that's a different issue. But it sort of frames the conversation for you. Let's look at some others. Let's look at, this is Hewlett-Packard. So Hewlett-Packard's a case where the company's had a lot of trouble, and the market is showing that. Look, if you just looked at their current earnings, their book and their current earnings, and then what it's trading at, people really think that this company is its best days are well behind it, and it's going to basically be destroying value going forward. And let's look at one of my favorites here. So this is our friends at Amazon.com. Now, Amazon.com, or Amazon, the company, doesn't have much book value. It does not have much earnings. So there's tons there's a ton of the value of the stock is in future growth. I'm definitely not here to tell you that the market is wrong, but what we're trying to do is very quickly say the question to ask on this stock is, can they meet into that growth? Can they really achieve that growth potential? Because there's a lot. You're seeing here a long-term, growth rate of residual earnings of like 9%. That means this is going to really, really go forward. And you may or may not kind of believe that. But if you're at a cocktail party and everyone says Amazon's going to grow forever, I would hesitate to guess that, it's going to be, let's just say, more of a risky road to think that it's really going to do that. Okay. So that gives you sort of a simple idea, this sort of idea of a risk metric, implied growth rates. High implied growth rates can be tricky. If it's a really, really negative implied growth rate, like it's going to fall apart, so maybe the company is going to go out of business, that can be sort of a risky sign too, or maybe it's just not valued. Now, one of the other sort of famous value investing things is margin of safety. Benjamin Graham kind of promoted this, and Warren Buffett and all the couples. Along with Mr. Market, I think it's just this great concept. The concept is that when you don't really see the future, so if you buy something, you need to buy it at such a price that even if something unforeseen happens that is going to sort of be negative, that you're still going to be okay. You have that margin. One of the tricks on this is that it can be really tough in practice to calculate. I mean, it's very easy to say, but this, it depends on this idea of what's the real intrinsic value of the company. I think that's a little, can be a little bit tricky to deal with, because having this intrinsic value can have a tendency to say, well, the company's really worth this much, and everyone else is just not smart enough to understand that it's really worth this much. And here we more are not really trying to place what we think the actual real value is. It's more we try and see what the market is saying the value is and comparing that to what we think it should be. Is it too high? Is it too low? It's trying to come up with the value of Apple Computer is 4.8765. We also do this in a little bit of a different way, because we don't want to just say, look at it as sort of a share price decrease, but we are long-term oriented investors, so we think about rates of return. So if currently what I think I'm buying a stock at and I think I'm going to get a rate of return of 10% goes forward, and that would be great, that's why I'm buying it. But if I'm kind of okay to only get a 7% return on that money going forward, then that is, I have a margin of safety of sort of 3% return. So it's just another way to look at it. And again, this ties back to sort of the economics of the company. Is the company going to generate 10% per year for the shareholders? Well, and maybe it only ends up generating 7% per year. But that gives us our margin of safety, and whether the stock market kind of reflects it or not is a different question. Let's look at some examples. So this is one of our tools on the site. It's a margin of safety calculator. It is basically, this is for Microsoft.com. So it uses a very simple formula. One of the nice things about a simple formula is it's very transparent, and it's not some black box, but it is a very simple model, so it has limitations, and we understand that. But here, again, we take sort of what I want as return on Microsoft, 10%, which is be a nice, healthy return for a company like Microsoft. I have the estimated long-term growth rate, the earnings, my kind of current earnings estimates, and then here we can sort of, by sort of plugging into that formula in reverse, we can see what the, what we think the sort of the intrinsic value is and what the return is. Now, from here, you can say it's looking like that's kind of where Microsoft is right now. I wouldn't expect it to return, it wouldn't be really reasonable for me to expect to return much more per year, and this is on an economic basis. What the share price does, I'm not sure. But you can also look at it different ways. 10% is a lot to expect from a company like that. So if maybe I really think I only need 8%. And in that case, you can see that, look, if it actually does grow that much and I only need, my required return is much less, I'm going to have a much higher, the company's going to be worth much more, but basically because I'm discounting their earnings back. But that just gives you kind of a very simple tool where you can, the value in these is really just seeing what happens. What if I don't think the earnings are going to be that? I can just change the earnings, and I'm going to see, look, that makes a big difference if they're going to miss those earnings, and I think the earnings are going to be flat. Having said that, if the earnings are pretty flat, and let's say they don't really grow at all. At this point, if the earnings are flat and they don't really grow at all, I can expect to get back about 8%. So if my real required return is 8% and they're only giving me back 7.5%, I'm not going to make that, so I have to sort of think about that as a case. But it's again a very simple tool to help you do that, to help you look at these. I have this slide for me. Don't forget to share. So if you do come up with some kind of analysis on what your opinion is on a stock, we provide the ability to send it to a friend of yours, and they can open up that, basically the page, and you can send a little note. It's like, this is what I think is going on, and they may or may not agree with you, but it's sort of a fun way to kind of trade your assessments with your friends. Okay, well, we're all here because we're at-risk users, and we are, very interested in simulations and Monte Carlo simulations. So let's take a very simple case. We've been through this margin of safety, but we've just been putting point estimates into the margin of safety, and in some ways that's not really reflective of the world we live in. That's why we like at-risk so much, because it allows us to do simple sort of Monte Carlo analysis things. So I just click on this. If you're on the actual margin of safety page, you can click on the dice up here. And what this has done is it's loaded in not just the mean estimates, but it's loaded in the sort of the low estimate, the mean estimate, and the high estimates for the earnings. Now we can see here also, say I think, the book value, they're saying 125, but I'm going to give them a little bit more credit. It could be up maybe as 145, and maybe they're carrying, some warehouse on their balance sheet that I don't believe is worth anything, or needs asbestos removal. So maybe there's a little bit of a range in there. The earnings growth, maybe I want to say, look, it could be nothing, and it could be maybe higher. Maybe they could be up to 1%. And now what we do is we can do on the site itself, we can do something very simple, which is just we can run this, and it will give you a little kind of distribution on what you're likely to see, what your margin of safety is likely to be. Now, here you can see, well, maybe there's a chance it's not a lot. Looks like I've got a little bit, and I could make a lot of money. But I think that's good. It's a big kind of back of an envelope thing. But people, like people on this call and others, are maybe going to want to do much more kind of sophisticated analysis. Maybe you have a different distribution that you want to do. And one of the goals of the site, we want to make that as easy for you to do as possible. So what we do is if you just click on the Excel export here, oops, hold on. Hold on, I need to actually start at risk. Okay, we open this up here. Give me a second. There's always something. Okay. So what we've done is we've taken all that information that you've put in, and we've downloaded it into kind of an at-risk friendly Excel sheet. From here, you can sort of just use the basic things that we've done, and you know, we've used some triangles and that. But here it allows you really the freedom to customize however you want to do it, and just saves you a step of having to actually manually copy those estimates in or get the book value, and you can do your own estimates. Right now, we just have this simple one. Going forward, we're definitely in the process of developing kind of more, again, we want to be simple, but maybe a little bit more complicated, or just sort of a few more things, so it's a little bit closer, a little less back of the envelope. So from here, we all are kind of at-risk folks. So you can always do, just run, at risk, we have 1,000. And so we can run our simulation on what's going on. And again, this sort of reflects where what we had thought. It looks like our upside maybe is more than our downside. We can always do your tornado graph here. You know, if anything, with any of these kind of systems, you're really going to see, you know, those earnings are really, really important, and that's definitely true. You know, and certainly one of the one of the difficulties with the model is what those future earnings are going to be. Also, what the long-term, if we had, say, a big variation in what the long-term growth rate is going to be, that's also, say this could go all the way from, say, like -2, you know, to 2. If we were to run that, and we do sort of our tornado on it, you can see how those growth rates and the earnings really make a big difference. But the nice thing about this, again, it's not really here to have the site spit out a Excel sheet, you run the thing, and you know what the answer is. It's more to do all these what-if scenarios. You know, what would happen if the range of the estimates were this? What happens if the earnings do this? And you really get a much better feel. That way, going forward, when the future becomes the present and the past, you are in a position to say, okay, I saw that as a possibility. You know, what can I learn from that going forward? But you've sort of, you've experienced it before many, many ways. Let's see. So we can do this with, you know, all kinds of shares. We can do Excel here. You know, so Amazon, if we want to do that. See what this tells us. So Amazon is telling us, wow, things look pretty good. Now, part of the reason that things look pretty good is that we are believing these growth rates. Well, one of the real inspirations on this site is the work done by Stephen Penman at Columbia, and he's done a lot of research to show that generally the residual earnings of a company will kind of revert down to what the GDP growth rate is, which is around 2%, because a company can't really grow faster than GDP kind of forever. So let's just say that that's a possibility, that maybe they go to, they really just grow, but it's not great. Maybe they, you know, they're worth something, and maybe the market's right. Maybe it's even better than right. You know, maybe they're really going to hit it out of the park. So at this point, again, we can do it. Now this shows that there's really, you know, because there's sort of so much downside risk, it almost kind of pushes like to, again, this is not the margin of safety. I guess I should put it on the margin of safety. The margin of safety is like really, really low here. because in those cases where it doesn't meet those growth targets, there's so little in the book and the earnings that there's just sort of nothing there at the company. Now, Amazon is what it is, but this was the situation of many, many companies in 1999, where huge implied growth rates, no book value, no earnings, and just the sort of mean is that they really go out of business. So again, I'm not saying Amazon's going out of business, but I think if you play with these numbers, it helps to frame the discussion that you're having. Let's go back. Okay, so now let's move to things with portfolios. We have built into the site something to help you with portfolios. This is kind of a newer addition to the site, so it's a little bit of kind of halfway there. But I'll show you what we have now, and we can go from there. So let me get here. So this is the dashboard that you get in Prudena. So this is where you would go. This is just a series of demo holdings for demonstration. And this is where you would go monitor your portfolio. We've tried to do a couple things differently here. We want to show people graphically their holdings and their weights in the portfolio in such a way that if you only 1% of your holding is Google, even if it's down 50%, you see that it's not really impacting your portfolio that much. Whereas 95% of your holding is Google, and it's down 10%. That's going to make a big difference. So we have these bars, and they only turn colors if the movement on the day is more than 0.5%. So there's a lot of noise out there, and we just we think that if it's not sort of a significant thing, we should just say we don't really know if that's an up move or a down move. It's just not really moving. It is what it is. We also do a couple other things here where we allow people to put in ranges so that, again, to try and separate what the noise is in the system, in the markets, from what I personally think is a significant move. So this is just set at whatever, if this is pretty, if Apple were to hit 385, maybe that's a little, yeah, who knows. So if Apple hits 385, that's something for me that I have to really look at what's going on. Maybe for me, that's something I want to get in and feel like it's a buy signal. If it hits 471, maybe I think that's worth too much. So if I'm in it, maybe I want to get out. The system will email you to tell you that you've hit one of those limits. What you're trying to do is sort of in your rational state, put down what you think are significant moves and noticeable moves. And other than that, just let kind of Mr. Market, do what he does. Some days he's in a good mood, some days he's in a bad mood. And the other thing we do here is we have the implied growth rates right here listed for you so that you have some bit of insight into what's going on with this. You're going to see every day that Amazon, the implied growth rate for what you require for return is very high. So you need to be wary on that. On the other hand, this is like very, very low. So you might want to ask yourself, why does the market think that this company is going out of business? Maybe it is. I don't know. Maybe they have a lot of assets on their balance sheet that aren't worth it. But it gives you sort of a more kind of fundamental view of what's going on a daily basis, as opposed to just price data, which could mean anything, as we've all known, living through since 1995 until now. So let's look at Monte Carlos. So Palisade has been very nice in that they've posted some sort of sample applications. I took the liberty of incorporating one of these into the site. So with this one, I have a bunch of shares on my dashboard, and if I just download the simulation, what it's going to do is this particular model depends on, as an example, it just depends on back data for correlations, basically. So we can pick the time period that we want. This is doing 2 years. And this is kind of outlined on their site. I think it's kind of a neat little thing to fool around with. So we can download this and open it up. table editing. And what we've done basically here is it's taken the historical data, it's calculated all the log returns for that data, and it's put it into a model, and it's given the portfolio returns. The last year's been pretty good, up 17%. You see that the annual volatility, you know, things are volatile. These are kind of tech stocks. But we're always, you know, as always, in the position to kind of run our simulation and see what our returns would be if this were to go into the future. And then we can always do our tornado and see what's really kind of driving the growth. And look, it's not surprising. Ford has had a crazy ride over the last year, where something like Exxon's much more stable company, so it's not impacting the volatility as much. Again, the idea really here is to take something that maybe could take a long time to get those things and just kind of do all the work for you, so you can spend all of your time doing the analysis and the thinking and the looking, you know, playing with the different weights, playing with things. You know, spend more of your time doing what you want to be doing, not with the mechanics. Oh, the other nice thing about this is that, say you take a different date range, say let's do 2008. I don't know if any of you remember that year. Say to 2009. If we were to export that, and you pull this up, so this has some very different annual volatilities. 4 to 138%. This is like the auto bailout. Crazy things. You know, clearly down a ton. So even in your mind, if you have a portfolio and you would say, look, what happens to me if this portfolio, we do something like we did in 2008, with just a few clicks, you can run this through. And again, there's so much downside. It's sort of going to push you down. You know, part of the reason it hits that limit is that you can't go below 0, right? So as soon as you're down 100%, you can't go down 100%. So it's going to kind of push you at that limit. You know, you're likely to be down. It's because mean loss is 25% down. Mode is 38%. So clearly not a great year for you. But on the other hand, if you have sort of a long-term view and you say, look, this is terrible and this happened, it may happen again, but I'm prepared for this. I know I have enough cash, you know, on hand, or I have other things that if this were to happen, I wouldn't be in a big crunch. Close out a couple of these here. Back to this. So this margin of safety for single equity is just what we had looked at before. And then one last thing that we have here is the kind of, you can take all those single equities and put them on one sheet. So this takes your whole portfolio on the dashboard and we'll put it onto one sheet. Then what you can do basically in a quick very, very quick way, you can just sort of stroll down to the bottom. And you can click on this. So now it's going to run sort of these portfolio things forever. And again, this is just a very quick way to get all your data down in one place. You may have some edits that you want to do, but right now I can tab through and I can say, okay, Microsoft sort of seems like it's, you know, a bit in the range. Oops. You know, ExxonMobil, you know, IBM, you know, these things, Verizon. So it sort of will give you your whole portfolio in a glance. You can just click through. Now, one thing I have not done on this yet, which is soon to come, is it would be nice to see this all summed up into kind of one sort of aggregate portfolio. You know, as many of you may know, there are kind of issues around doing this because, you know, what's the correlation between the different assets and things like that. So I've sort of left that off. But if you have very good ideas about what you want to do, you know, say, for example, you had a business climate factor that you wanted to put in. You could very easily just add that to the bottom of the sheet with, with each individual's equities correlation to whatever that business climate variable is, and you have all these places in one place, and you can very quickly do the kind of simulations that you want to do on your portfolio. The last thing is that this is a bit almost like an educational tool. People and actually one of the Columbia professors used this in a class to sort of demonstrate modern portfolio theory. We do that here. Oops, wrong link. We can, again, take your portfolio, and this is where you can compare two different portfolios, and we can sort of run the Monte Carlo, on these to see what happens, and we'll show you the distribution of returns, again, using some kind of backdate and a risk-free rate that you put in. It's going to give you the correlation matrix. It's going to give you, what could happen in the future. And for someone who's just getting started and is looking at what diversification will do, it's kind of an interesting tool because, for example, you can see in this one portfolio, say I have 5,000 shares of Google, and this one I only have 5. If I go down here and I look, well, first of all, you can see, look at how much more varied the returns are on the first portfolio, because it's all in Google. Whereas the second portfolio, even though it has the same holdings, since it's more evenly diversified, it's got a narrower band. Having said that, the returns, if things go well for you, since you're so focused on one equity, look, life is good. Google went up. That's great. But that, again, this is if we picked a different date range, it might not be so good. And you can see it mimicked here in the volatility of the portfolio. The first one has a much higher standard deviation on the volatility than the second one. And for an educational, again, simulation tool, I just think it's kind of a neat little way to do things. A little bit more, I guess about 5 more minutes on the site. On the site, you can have sort of as many portfolios as you want, and you can decide which one of them show up in your dashboard. So if you have different accounts, you can keep track of those. We allow people to keep track of their trades. So if you want to sort of keep track of when you're in and out of things, to keep track of what you were thinking, what your reasons were. We have a little bit of a kind of a risk screen, and what it basically does is you can look at, say, I want to look at the S&P 100. And I just want a general idea to see what people think are the companies that are going to be falling apart, which looks like Hewlett-Packard, Bank of America. These are gigantic companies, so there's a lot of stuff you can see that's sort of in this core area. But then companies that are doing, better or have very high implied growth rates, I mean, people think they're going to grow a lot. Goldman Sachs, some of these other, Amazon, and that should just be something that you're asking yourself, why? Why is that the case? Do I believe it? You're not just going to say, oh, it's got a high implied growth rate. Like I'm definitely going to. It's got a very high, these are ones falling apart. So it's got a really negative implied growth rate, means people think the company is going to fall apart. There's no way it's going to fall apart, so I'm just going to buy it. That's not really the goal of this. It's just a way to help you think about it. We have basic account stuff. And as far as the site goes, that's pretty much the core of it. Let's see. As I said, the next product, I guess, that we're going to come up with is we're going to call the Morning Monte Carlo, where basically you can subscribe, and every morning in your email box you'll get kind of a report of maybe your dashboard, and it will send you some of these Monte Carlos. If you're interested in receiving that, please let me know. That should be kind of available in the next month or so. I should note that the site is live now at Prudena.com. Pretty much everything I showed you is kind of free. You can just sign up. The only thing, sometimes if it's an equity that's not a very popular one, I might not have the estimates for it, so you have to either contact me or something to get the estimates in and sort of added to our sheet. We have to pay for the estimates, so we don't just kind of grab the Russell 2000 or something of estimates. But if you have something, please let us know. But generally, keeping track of your portfolios, the basic tools for that, it's all free. This morning Monte Carlo would probably be sort of a small subscription to have us just send that to you. And I think with that, I'd love to open the floor to any questions that people might have on the system or what we're doing. And I'll try it.
Well, Charlie, that was great. That was so interesting.
Great.
And I will, before I ask a question of my own, I want to see if any of our attendees have a question. It was a very exciting interface, and we don't have that in a webcast before, and I think a lot of
great.
Not only finance people, but also people want to do their own custom development.
Right.
And
I should know one of
and some things you said about Amazon were really interesting, and I hadn't thought about that.
Yeah, again,
so this was interesting on many levels to me. So
right. So you sort of think about, again, I'm not here to give advice, but I am here to help you point in. If you're going to go sniff out what's going on, here are the things that you might want to look at, and at least try and get a feeling for. Okay, everyone thinks Amazon's going to grow so much. Like, what's the story? Like, do you believe the story? It might be that you don't know, so you just stay away. It might be, that's often the case with things, right? It might be it's 100% of your portfolio, and you're like, maybe that's not a good idea.
Yeah, maybe.
Again, I'm not giving advice.
Well, good. Some of our attendees are already signed up on your website, so that's.
Oh, great.
Let's see.
Great.
Do we have I have one question actually that's in the chat panel, so I might take the.
Yeah, you can take it back.
I mean, in the Q&A panel, so I
can
only see that if I do this. I'll take that.
Yeah, just take it back.
Let's see what I got here. Oh, one question is, will this work on tablets?
It's a website, and I have a Surface and an iPad, and it should work fine. I do check it to make sure that it works.
Okay.
It's not. It's not a native tablet application. If someone uses on a tablet and they run into a problem or something, it's definitely our goal to support them. So just send us an email and we'll make sure that we take care of it. So if it works, it will work fine for you.
Good. Let's see what else we have. We have some thanks for the presentation.
Oh, great.
Just wait a minute more. Were you able to use the developer kit in our software to put this together?
So I didn't use the developer kit, the actual Palisade developer kit. The things that I'm doing, I just wrote those on my own.
Oh, wow, that's great.
So the Monte Carlos that are in the site, I just wrote those on my own. But I mean, as you know, you have it's so powerful what you can do. The goal is really to have kind of sort of the simple vanilla things on the site, and then if somebody wants to really dig in to do something that requires more horsepower or is more complicated, to give them the very easy way to dump that into at-risk and export it.
Good. Oh yes, and everybody, we're recording this, so we'll be sending a link out to all the attendees, and if you watch this recording sometime in the future, please feel free to reach out if you have any questions also. And after we're done, if you have any questions, you can email me, and I'll probably send out Charlie's contact info also, and just on the website. I don't see any questions right now. Sometimes they come along later. You can just wait another minute.
Well, I'm certainly always, you can always contact me through the site if you have any questions. You know, as you probably can see, we have kind of a lot of the basic things doing. So now we're really focused on more refining the tools, but also, you know, working with some of our users to make sure that we are kind of simplifying their lives and providing them with the kind of, you know, at-risk exports or you know, on-site screens and tools that they want to use. We'd also like to sort of expand. Right now we're just doing basically U.S. equities. We'll probably like to look into incorporating other kind of instruments into the site as well.
Wow. Well, you're definitely you're in the future. You know,
for better or worse, I guess.
A great place to be, I think. Yeah. Oh, this is great. Well, we really appreciate this.
Great. Well, again, if anyone has any questions, please let me know.
Yes, yes, and thank you so much, Charlie.
And look, thank you for having me here, and I look forward to seeing you guys in November.
Yes,
if
sounds
not
good.
before.
Great. Well, thank you, everybody.